way to understand our margins is not just straight comparison of, what was 9%, what was 8.5%, what is 8.25%, etc. Our effort in running our business is to create value for shareholders apart from customers. And one of the levers that we use for creating value is the absolute profitability, which is reflected by the margin number. And the second is the capital efficiency. Now, what is possibly getting overlooked in this assessment is the capital efficiency that the company has achieved during FY24. If you look at the working capital intensity that we started the year with, we were almost at 18 to 19% of our revenue as funds employed to earn that 8.5, 8.6% margin that we reported last year. Now, in the current year, FY24, we have pulled back almost 4,000 crores of capital from our investments, business investments. And the working capital intensity is 12% of revenue as compared to 16, 17%. And the margins are at 8.2% as we have reported. So in a very simple analogy, if you invest 100 rupees and make 10 rupees, you get a return of 10%. If you invest 80 rupees and make 8 rupees, you still make 10%. The comparison of 10 versus 8 and to actually agonize that the profit have come down would be not full appreciation of the dynamics of the financial performance.
I wanted to also touch upon these order inflows, and that was a little bit muted due to the elections, but I want to understand what the outlook is ahead. You've given that order inflow guidance. What's the outlook when it comes to the execution visibility that this provides? Do you think that the Lok Sabha elections as well have a factor to play here?
We are pretty confident looking at the pipeline that we have ahead of us. I think the next 12 months does look like it can generate close to 12 lakh crores worth of orders, both India and overseas. India itself could be about 7.5 lakh crore out of this 12 crore corpus that I'm talking about. So the prospect is quite fine, except that we are heading into a year which possibly is a 7-month year or a 8-month year, because by the time the elections are done, the new government gets formed, bureaucracy gets reshuffled, reformed, etc. It's going to be July, August by the time business gets back to normal. Now, given that we had a very large base to start with at the year, a 3 lakh crore order win of the previous year, and we had to grow on that, and fact that we're going to have a bit of a truncated year in terms of order inflow, even though the prospects continue to be encouraging, we do think it is appropriate that the absolute growth may not be more than 30,000 crores over the 3 lakh crore that we have reported.
Okay, fair enough. And what's the outlook then when it comes to the Middle East and your international orders? Because I understand that the region is seeing impact of, disruptions due to the Red Sea or be it geopolitical issues. How is that impacting your overall business in terms of investments in oil and gas, etc.?
For the last 3-4 years, the stress on oil and gas being the only source of order inflow from Middle East has been changing. We do think that Middle East has realized that out of the earnings of the oil and the gas resources that they have, they need to divert that resources into broader development of infrastructure. Over the 4 years, Middle East has got into downstream industries. It has got into building cities. It has got into building rail network. It has started electrifying the country far more and adding more destinations like Dubai to its map. Considering all this, I think the opportunity that we see in Middle East is far wider than just what hydrocarbon can produce. For example, the solar transition that is happening in Middle East is very significant. We ourselves as a company are executing close to 18 gigawatt of solar power projects, the largest operating contractor on the ground today as we speak. And these are large investments. So considering that Middle East is actually using the black fuel to finance their green plans is a refreshing change. And I think much of the focus of Middle East has also been to promote local supply chain. Of course, the geopolitical tensions and the logistics challenges does pose some time constraints and also cost overruns. But beyond that, if you look at almost 20-30% of what we source are going to be sourced from the Middle Eastern markets themselves, it does give encouragement that the order flow will continue to come through from Middle East for these sectors.
Okay, and you had manufactured the first indigenous electrolyzer in Gujarat. Post the completion of the testing, when do you start orders from the domestic and the international markets? How will you look to scale up the manufacturing for the 4 megawatt electrolyzers? And what about the allocation in terms of the funds for PLI for the National Green Hydrogen Mission?
I think the electrolyzer so far has come out well in terms of the functionality features testing that we are currently doing. I think we expect to complete the testing process maybe in a couple of months from now, because we must also appreciate that this is the first electrolyzer that the country has ever done, and it is done on the alkaline technology. We think that the future lies in packing more megawatts in the electrolyzer stack. While the initial orders will be for 1 megawatt and thereabout, but the larger orders and the larger play would be when we have 4 megawatt. We are working with our technology partner. As you know, the technology is not available in India at the moment for these electrolyzers. We're working with our current technology partner. We are also working at alternate technologies because in addition to the alkaline, the world also has a PEM, membrane technology. The cost economics needs to be worked out, because end of the day, if it is not going to be cost effective, hydrogen as a source is going to have its own challenges as the world is battling inflation. So given all of this, we think that in FY25 we will get our first orders for the 1 megawatt electrolyzer. By end FY25 we should be ready with a 4 megawatt. If you're able to crack that, then FY25-26, we should be able to get some orders for 4 megawatt.
Okay, and I just wanted to understand a little bit more behind the decision not to participate in the thermal power plants, because I believe you want to utilize that on international orders. And what is the outlook then in terms of your overall working capital, where you're looking at for guidance for FY25?
We've done very well on the working capital in FY24, thanks to all the business teams. We've reported 12% to revenue, and we've been operating in the band of 18-20% for a few years now. So 12% is a fantastic achievement. And the effort obviously would be to sustain that kind of efficiency. And the guidance we have put out for FY25 on working capital will be in the band of 12-15%. But by and large, I think it would continue to remain one of the efficiency lever that we use for return generation. Insofar as thermal plants are concerned, I think it's a question of where we would like to place the bet, keeping the next 5-10 years in view. We had a large thermal plant business, coal-based power plant. We think that the terms of engagement for coal, the technology that is in use, the climate change pressures, the need for us to get higher on the ESG ranking. If you take all of that into consideration, it looks to us that we have to migrate to green. And it is not very possible for a company like us to keep straddling both with equal attention, because end of the day, the resources are limited and they need to be allocated sensibly. So our bet is on sort of letting go the coal-based power plant and move to solar, renewable, basically renewable, and a bit to hydrogen as well. So that's a very considered move. We do think India is far away from abandoning coal. So there will be opportunities for coal projects that will come up. But I think just from a point of view of focus, I think the focus has shifted to renewable rather than to coal. We have almost 5,000 crores of orders in the book for coal projects. So it's not that we are abandoning coal. We'll continue to complete our commitments. And if there are along the way some opportunities which are compelling, which makes sense for us to stay engaged, project teams fortunately have fungible skills. So we'll continue to use those skills and attend to those.
All right. And, earlier you had said in your 5-year plan that the order intake for FY26 would be about 3.5 lakh crores. You've already crossed 3 lakh crores for FY24. You're ahead of the plan, clearly. Are you going to be revising the order guide inflow target based on this? And what's the outlook in terms of your strategic roadmap now?
I think you're right. We are quite likely to exceed the 5-year targets that we set for ourselves. One of the covenants that we have in the company is once we define a budget, whether it is annual or for 2 years, 3 years, 5 years, we don't change that guidepost. We keep that guidepost. Constantly compare how we are achieving with that guidepost, and sometimes we get better, sometimes we fall short. So I think we're not changing the targets that we set for ourselves for FY26 because it's more strategic direction. But given the fact that India has invested well in the last couple of years, Middle East has invested well, given the fact that the clients have found us competitive and very relevant for their plans, we've had the benefit of those tailwinds. And I think they would continue through the rest of the period. So we will end FY26 well ahead of the order inflow plan. We could well exceed the revenue guidance as well because we did say 2,70,000 crores by FY26. We are already at 2,21,000 crores in 24. So maybe with a year to spare, we could cross those. The third important piece is we said we'll possibly make a return of equity of 18%. We are at 15% as we speak, and we have the next 2 years to reach that guidepost as well. So all in all, I think it'll be one of those 5-year plan which the company would have successfully met.